Gold got a bit of a bounce this Monday morning after a slight pullback in the U.S. dollar. And what can we expect ahead of this week's FOMC? We have Frank Holmes joining us now. Frank, good to see you.
It's good to be back.
Well, we're glad to have you back, Frank. It should be a very exciting week ahead of the FOMC. And on that note, what can we expect from gold? How do you see it set up here ahead of that much anticipated meeting?
Well, I think the big factor is going to be CPI numbers, because the CPI, when we look at the trend, has had a big impact on the spread. So what we mean by that is what will the U.S. government pay you on a 5-year government bond versus the euro? What will they pay you? Take away the CPI, the inflationary number, and you either get a positive or a negative rate of return. Whenever it's negative, gold is strong in that country's currency. Whenever it's positive, gold is weak in that country's currency. So in the U.S., it turned massively positive this past month. So gold is taken on a chin, and the dollar has been strong versus the euro. Right now, it appears to be a crowded trade, and everyone long the U.S. dollar, and we're due for a correction.
And Frank, you're beating me to some of the opportunities. So let's get to it. Let's get to the opportunities and threats segment now of the show. And you brought a really interesting chart which looks at the inverse pattern of gold versus 5-year treasury yields, which you now say is very profound.
Well, we go back and take a look at the trend that took place in March of 2013, a couple of years ago. Gold was 1,600, and the U.S. government was floating 5-year government bonds. And when you take a look at what they were charging on those yields, you can see it was 1.57 minus 2% CPI. So investors are going to get a negative 0.3% on their money. A year later, you can take a look, you can see that they're now negative. That is, they're actually getting a positive rate of return. And that immediately had gold fall to 1,300. And now, March 15, we have the gold at 1,100, 1,150 range. So what's inflation? It's so beautiful that the 5-year government, U.S. government bond, it has a big positive rate of return, the biggest in many, many quarters. So it's 168 basis points of positive yield, not negative, where like it was a year ago. So that's important to recognize it. So that's what I try to show you. The visuals I've written many times on the website. That's what drives the short-term actions in gold.
All right, Frank, one last opportunity has to do with the S&P and mining stocks. And I'd like to bring up this chart that shows that S&P 500's returns in the past 6 years have been the best since 1929 and 1999.
So we've had a spectacular run in the stock market, unprecedented 6-year runs, and everyone's been so negative on the government. But we've written about this, follow the money, follow the money. So this same thing here. Right now, they're printing the money in Europe, and you want to be long European stocks. And if you're in Europe, you want to be long gold in addition to high dividend paying stocks. So I think that that's the real issue. Will the stock market have a correction in America? There's a high probability based on that 6-year run. What should investors do? I don't think it's going to be interest rates rising. I think it's going to be more a factor of the strong dollar is going to hurt exports.
And adding to that phrase that I mentioned earlier, gold miners currently stand at being historically very cheap, Frank. And given the stark contrast, you say it would be prudent to add mining stocks now to one's portfolio for diversification.
Well, absolutely. And that fits right into the whole thesis of gold stocks are trading at cash flow multiples that are 1/3 of the S&P 500. Some of the negative news just recently came out is that many of them will have negative free cash flows, and one can easily screen those stocks that will do well. And I've always advocated royalty companies just seem to have the strongest balance sheets and income statements when you take a look at on a relative basis, so they will do reasonably well. But I think the big cap gold stocks still are trading at the most attractive real rates of return. And Canadian companies like Goldcorp, et cetera, are trading at very attractive cash flow multiples.
All right, Frank, on to threats now, and all eyes on India's new gold savings plan, which could negatively impact physical demand for gold in the country. With Indian households estimated to own about 20,000 tons of gold, even if 5% of it were to be unlocked by the new gold deposit scheme, it could reduce the country's imports by 1,000 tons.
Yeah, and that is a real concern that's been advocated in the capital markets in the space. But on the other hand, I think it's a positive. I thought, well, take a look what's taken place in China. Of having people save, and you get 1 million, 2 million, 5 million, 10 million people saving every month, putting away a gram of gold in a savings. And young people are more prone to doing as a financial investment, whereas India is still, I don't think you're going to take away from gold as a loving gift. I don't think that it's so important to recognize the idea, the concept of giving gold because you graduated, because you got married, because you had a baby. It's just very deeply ingrained in the culture.
All right, Frank, finally, let's wrap with your touchdown pass of the week. It's got to be the FOMC.
Yeah, and I think what you have to be recognized is this whole thing of artificial intelligence, or mechanical learning, as you'd like to call it, that more and more of the big funds like Bridgewater has commented, Dalio putting $25 billion towards this space, that they have Google searches on steroids, basically, and they look for these words, and certain words show up, and all of a sudden gold will move or stock market will move, and it's how fast this happens. So investors have to be aware, and they can go and Google artificial intelligence in the financial markets and learn more about this thesis, this thought process. And that's what moves these markets so much more quickly.
Well, we'll wait and see. Thanks so much, Frank. We'll see you next week, and we'll see you tomorrow.